All right, welcome everybody. This is going to be a little bit more in-depth conversation on our simulation. I know we've set the stage a little bit in the past couple web conferences and past couple recordings, but really wanted to go through and provide some more strategy-based thought process on this and set the stage for you guys as we move into the first practice weeks. So just so we're all on the same page, 3 practice rounds and 4 competitive rounds. Each round of the simulation actually takes place in 1 calendar year, so January through December, and the important reason for that is so that we actually have the ability to see changes in the marketplace, implement the decisions that we've made, and lastly, everybody's working from the same starting point, right? So as the big company's been broken up into 6 equally sized companies, you have access to all the same information. Your statistics, your market shares are all the same at this point in time. Whether it goes up or down from now or from this position going forward is strictly based on your ability to make good strategic decisions. And also, in order, or as we start this, each company has 1 product in each of the 5 market segments. Now, spin that forward, it doesn't always have to be that way. I mean, if you guys choose to eliminate a product or move around products in market segments, you are able to do that as well. We are only working off of our class of Andrews, Baldwin, and Chester. Our student-led teams, Digby, Erie, and Ferris, will be the computer-based teams. The product names that you have in each of the categories are listed below. I've checked with Capstone, and we are unable to change team names at this point in time. They are locked into Andrews, Baldwin, and Chester. So we all know what sensors are. I mean, it gives you a little bit of a definition right there. I'm not super worried about that, but in case you need to go back and look at it, that's where we can kind of base our decisions on. So let's move forward. Customer buying criteria, right? What do our customers care about? Well, 4 main things. Price, obviously. Age, how long a sensor has been on the marketplace. The longer, the more time that has been, you'll actually find a couple strategic decisions coming out of that, and I'll leave those topics up to you. Mean time before failure, obviously we're talking about quality at this point in time, and then positioning, and this really refers back to the physical size of a sensor and also the performance, right? The level of speed and sensitivity. We want more speed, we want smaller size. And depending upon who our customers are, they're going to care about one or the other. Hold on 1 second. There we go. So let's look at a low-end segment versus a performance segment of the marketplace. Obviously, the perfect product score is always going to equal 100, right? But as we look at it, different customers are going to want different things, and it's a different mix of those 4 areas. So when we look at the low-end segment, the age doesn't necessarily matter, right? It wants reliability. From a price standpoint, they're going to want a lower price point, and then positioning and failure time obviously have importance in there as well. However, when you look at the performance sensors, what we're really looking for is that performance rating, size and speed, right? And so from that standpoint, they put a much higher importance on the positioning part of it. Price obviously has a factor, and failure time has a factor, but they always want new and they want high performing. So just when we start to look at the different types of customers, you're going to see a different type of sensor and as a result, different type of strategy coming into play. If we just look at the industry conditions report, everybody has the same information again, right? It's going to be published once at the beginning of the simulation. Everybody has access to the same thing. Changes every year for each product segment. Let's look at that real quick. Positioning, we want smaller size, we want better performance. We're going to have to figure out what that means on a case-by-case basis. And also, we have to look at the price, right? It's going to drop 50 cents per year, and that is an industry standard. Requirements that stay the same. We don't need to worry about the preferred product age. We don't need to worry about the preferred mean time before failure as well. Obviously, we want better from those capacities. But if you look at it, the age of the product isn't going to change. It's always going to increase. We don't have to worry about that. As we get to the market segments, I'm going to talk a little bit more about drift rates. And as we just look at the perception maps right here, right? Rough cut versus fine versus ideal, and where we are really going in terms of how our customers view the product. Obviously, low end has a bigger size and lower performance, and vice versa when compared to high end. But as we kind of flip this through, and we're going to look at some of the drift of this, what do we want to be looking out for? One, the positioning, right? If it's outside the rough cut, we're not going to have any demand for the product. This is the minimum criteria that the customer has for it. If it's entering, if a product that we have is entering that rough cut, R&D, the person in charge of that, is going to have to go back and implement more changes to that product line, try and get it closer to that drift. When we look at pricing, if you price your sensors at $5 above or below what that market segment is going to be calling for, you're not going to have any demand. You're going to be outside of that main target market and that market share. But remember that prices are going to drop every year. Meantime before failure, 5,000 hours below the range, you won't have any demand as well because the product is not reliable. So let's look at what that drift really means. As we go through the rounds, the low performing products are going to shift, right? Even the low performing ones are going to become faster and smaller. But when you look at the difference and how much that drift has actually impacted the low, then compared to the high range of products, yes, they've gotten smaller, yes, they've gotten better performing, but it's also the fact that they've done it at a much faster rate. And I think when we look at that, we can ask ourselves why. There's a lot of answers for that, but what I would always go back to in answering that question why is probably where people are putting their research and development dollars. They are always trying to advance what that industry is going to be. Other demand factors that are going to be out there that increase or that impact what our customers are trying to get from us or how much they purchase from us. Accounts receivable, if we offer more credit, if we put off the terms of payment, obviously we're going to have higher demand because of that. As a general standard, a 90-day payment policy is best. From an awareness standpoint, what's the advertising that we're doing, right? Do our customers actually know what's out there? The marketing manager is going to have to deal with that. And then lastly, from an accessibility standpoint, how does a customer interact with our company? Is it through a sales force? Is it through distribution? We have to make that decision as well. And again, our high-performing products should probably have a sales team behind them. They shouldn't just be out there on the marketplace by themselves. So some of the data that everyone is going to have in order to make decisions, and I would just draw your attention really quickly to the blast on the right side of the screen. Everybody has to have communication and collaboration at this process, right? This is not strategy in silos. We have to work together. As we start the simulation, everybody has access to the same industry report. Everybody should go through it and understand their key areas. On a round basis, the Capstone Courier will be published. It will show what has happened looking back. And this is for the entire industry, and this is for the players and the market segments and the products inside that industry. We're also going to look at a situational analysis. You guys have done these before. It may have been under a different term, but I'll get to that here in a second. Pro formas, annual reports, what might happen in the next year? What is going to happen to industry demand? What's going to happen to capacity? What's going to happen to drift? And from that standpoint, it's not just what we are doing, it's what the entire industry and the other companies in the industry are doing. And then lastly, we have the Capstone spreadsheet. We're going to use this to finalize our decisions on a round-by-round basis. So some of the different markets, or I'm sorry, the roles that we have here, who is responsible for what? Research and development, you're going to be responsible for revising each product, right? So as products start to fall outside of that rough cut area, we want to make sure we're investing in each one of those products. From a production standpoint, we want to look at adding capacity. We want to look at whether automation or labor is a better way to go. And we also want to look at what our inventory costs might be. Marketing, set prices. We want to make sure that our prices are going to be relevant to the marketplace. We want to be able to allocate money towards advertising awareness and also our sales force as well. And then lastly, finance. After everybody's basically made their decisions and the strategy's been set, it's your job to find out where that money is going to come from. Whether it's for managing cash flow, whether it's what your dividend policy might be, issuing returns, or if we need more capital, how are we going to get that? Maybe it's through selling more stock, issuing more bonds as well. So there's going to be a lot of different things as we kind of go through this process. Go back to situational analysis. From an external standpoint, it's just a SWOT analysis. That's all we're looking at. What opportunities are out there? This is where that segment drift and Capstone Courier are really going to come into play, because they're going to give us a good lay of the land about where the industry is going and where we could be spending our money. And then lastly, threats. We already saw that the low market segment drifts at a slower rate. Yes, we can predict more with it, but if the customers are getting out of that marketplace, maybe we need to watch out with what we're actually trying to do. From an internal standpoint, same thing, situation analysis, strengths and weaknesses. What are we doing well? This could be from a capacity standpoint. It could be from having really great contribution margins and making a lot of money off of certain product lines. And then as well, where are our weaknesses? Are we investing too much in automation? Are we investing too much in R&D in the wrong areas? So we're going to have to run this analysis on a week-by-week or a round-by-round basis. When we look at forecasting, I think there's a couple things with this. The Capstone Courier is really going to come into play with this. What actual sales versus potential sales might be, what is changing in the industry. But as we kind of roll through this whole process, I think we need to look at that basic forecasting calculation. Your unit sales from the last year multiplied by 1.0 plus a growth rate percentage. Where would we get that? We would get that from the Capstone Courier. And then we would look at this year's unit sales potential. The marketing person, the finance person, R&D, everybody's going to have to get together on the same numbers here, because this is really the core of your strategy decision. I already know that we've had a couple questions about capacity, so I want to address that as well. I think we have to look at capacity as a labor versus automation question, right? And this is the same thing that companies in the real world are having to make right now. Do we invest in robotics and automation, or do we double down on labor, physical labor? So from that standpoint, I think we just need to look at the options that are available. You have the potential for two shifts, right? First and second shift. The second shift is going to be more expensive than first shift. If we limit our capacity in terms of having one shift, we limit our output, we limit our sales, things like that. We would also should be looking at plant utilization, especially when we get to the competitive rounds, because it's going to show you how much you're producing versus how much you could be producing. And you should play this against your competition as well. From an automation standpoint, obviously it reduces the need for workers. However, it does require time to go through that automation process. So if you choose to re-automate or automate your facilities, you will have to spend time and money in the form of a round, and you may not get as much production out of that initial round. Consider it just on a sliding scale, right? The lowest automation is going to be a number 1. The highest automation is going to be a number 10. And you can kind of see where you fall along that continuum. Production costs, we're going to look at capacity next round versus overall industry capacity. And from that standpoint, we want to look at some of the main things here, right? This is going to be the total capacity for this next round. Plant utilization from a traditional and a low product line. And we're going to kind of see if we're working at full capacity or where we could shift our monies around to. Well, in terms of production costs as well, let's just say we don't want to automate. The cost to double capacity, obviously, it's $6 per unit floor space versus $4 per automation level per unit, so you're going to have some increase there as well. But it's also going to impact morale in terms of workers too. And from that standpoint, maybe capacity suffers when they see the second shift coming in as well. So from that standpoint, it can't just be what we have increased our automation to. The maximum automation level minus whatever you're currently at is going to be the automation increased. So if it's $4 per level of automation increased per unit produced, it's going to take a full year. It's going to go that full route. But then if we look here, automation costs of $4. Final cost is $1,200. 3 levels times 4, 1,400. Yeah, 14,400. So as we see, we're going to have this process that we can work through too. Productions and labor relationship. Obviously, your laborers are going to get annual increases. As that plays into it, if that's what you're choosing to pay, just know that that's going to go up every year, right? Automation is, yes, it's attractive, and yes, you have to invest in it, but you don't have to pay for it year after year after year. Your lower automation will have higher labor. Your higher automation will have lower labor. And that just shows you what the production levels are as well. As the years of automation go up, the automation level goes up as well. When we turn in terms of eliminating product lines, if that's the route you choose to go, and that's an okay route too, right? We said we have one product in each of the 5 market segments. If you want to get rid of one of them, go for it. We can allocate that time and money someplace else. However, when we do that, changes happen, right? We liquidate an entire unit. You're probably going to sell it for about half of the production cost. It will be a loss on the income statement, so we're going to liquidate it in terms of that. But then, from that standpoint forward, you don't have to worry about that product line anymore. When we look at it, it comes down to what your finance manager is going to come back and say, well, we're losing that capacity on that line, we're losing that capacity on automation, whatever we've invested in it. And so there's not just a product standpoint question we have to answer, but also a finance point of view as well. So at this point in time, I know we're wrapping up here. We've looked at manufacturing, we've looked at marketing, we've looked at R&D, competitive research, all these other things. The CEO is ready to make their decision, but finance has to be able to wrap all these issues together in one fell swoop. So when all the strategy is set and all the decisions have been made, then comes the question of, well, where's the money going to come from? If we're doubling down and investing heavily in automation, but we don't have the cash flow to be able to meet that, we're going to have to raise some type of financing. Whether that is through not issuing dividends, whether that is through cash flow, that's a question that the finance manager is going to have to pay attention to. So here's just some suggested actions to take as we are still in the practice rounds. I would suggest, as a group, potentially eliminating one product line. I want you to see what happens with that. I want you to be able to test that out, and as a result, see where that capacity goes. See where you can invest into different places. Launch one new product. If you want to do that, that's great. Please do. But also know that that takes time. That takes a full cycle at least before you're going to get it to the marketplace, before you can start to even see any new return on that investment. And then lastly, potentially look at repositioning one product to a different segment. And what I want to do is I want to look at an example of that. Let me get back up here to our drift tables. Here we go. So as we look at these things, at the market segments and the products and where they are drifting to, obviously you see there's going to be some overlap, right? As some of the high performance products really transition at a much higher multiple, the low product really isn't moving that much. So potentially what we could do is we could look at just eliminating this low performing product. Maybe the customer base just isn't there anymore. Maybe they don't care anymore. Maybe we're not performing well there anymore. But what we could do is we could take a performance-based product and transition it over to a traditional. It's going to have a higher performance. Maybe we can try and lower the price a little bit, keeping the size down as well. But if we can try to change our positioning inside each one of those, what's going to happen is we may be able to take advantage of market share. We're going to look at the Capstone Courier. We're going to see what the industry is doing. We're going to see where our competition is looking to invest. And as a result of that, what we can try and do is try and be strategic with our decisions and take advantage where other people have fallen down, ignored, or not performed as well. So whatever questions you guys have, let me know. Get in touch with me as soon as you can, and I'll make sure and get back to you. But hopefully that provides a little bit more concrete information on our simulation. Have a great day, guys. Bye-bye.